For several years, I've been keeping my eye on a company that I thought had potential in terms of being a decent, high-yielding dividend stock, but the reason why I was so skeptical to talk more about it and buy any shares myself was because it was such a new company, having only been publicly listed about 5 years ago. There simply wasn't a long enough track record of performance for this stock where I thought I'd feel comfortable really getting into the details about it. On top of that, another reason why I wanted to stand back and observe it was because on one occasion the company did fail to pay a dividend for 1 quarter, which was during the worst of the pandemic. It's since restored its dividend to its normal level, but that was another reason why I wanted to just observe it for a while. The whole reason why I wanted to keep my eyes on this stock was because I saw this company had a few nice things to like about it. As of the making of this video, it currently trades for less than $5 per share, which makes it an attractive buy for people looking for an inexpensive dividend stock to invest in. It also currently yields 10.5%, and their financials have continued to move in a positive direction over the years. And with everything going on in the housing market, I think things are going to continue to look good for this stock going into the foreseeable future. The company I'm referring to is Sachem Capital Corporation, ticker symbol SACH. Sachem Capital operates as a real estate finance company. They're involved in the originating, underwriting, funding, servicing, and managing of a portfolio of short-term loans secured by first mortgage liens on real property primarily located in the northeastern United States as well as Florida. Sachem offers loans to real estate investors and owners to fund the acquisition, renovation, development, and improvement of residential or commercial properties. Right now, Sachem Capital trades for $4.57 per share, which is 47 cents less than its IPO price back in February of 2017. But it is currently down $1.49 for the year, meaning that before all this volatility started in 2022, this stock was trading above its IPO price. It was looking at roughly a 15.49% share price gain since its inception before the year 2022 started. It currently pays a dividend of 12 cents per share every quarter, giving Sachem a dividend yield of 10.5% according to Google. Sachem is currently one of the smallest REITs out there, but they've continued to experience some really impressive growth over the last few years. They used to only provide financing in 6 different US states, whereas now they operate in 14, mostly in the northeastern United States as well as within the Sun Belt, which is an area that's exploded in terms of popularity since the pandemic. Their average loan amount has also increased dramatically while also shortening their average loan term maturity. This helps reduce the amount of risk the company is exposed to in terms of both defaults and interest rate risk. This growth is also apparent when we comb through their financial statements. Net interest income has continued to trend upward over the years, and even just looking at the last few quarters, things have really been moving upward for them. Their book value on their balance sheet also keeps growing. In the first quarter of 2022, Sachem had a book value of $5.61. Since their stock currently is trading at $4.57 per share, this indicates that the company is currently trading at a discount, again thanks to all the volatility we've been seeing in the market this year. If you've watched my channel for a while, you might know that mortgage REITs aren't exactly my favorite type of investment out there. This might sound weird given what my channel focuses on, which is high-yielding dividend stocks, but the fact is I'm just not as big a fan of these kinds of companies as I am equity REITs, business development companies, and covered call funds. There are some REITs that I do like, such as Ares Commercial Real Estate, Ready Capital, and Starwood Property Trust to name a few, but the fact is that this sector has a lot of crappy companies in it. Some of the largest and most well-known REITs have seen a consistent drop in both their share price and their dividend distributions. Take Annaly Capital, which is the largest REIT out there. For more than a decade, this stock has seen a steady decline in its share price and dividend distributions. The same can be said for Armor Residential, which has lost almost 90% of its share price since their IPO back in 2007. And then of course, who could forget Orchid Island Capital, which is down about 80% since being launched in just 2013. In order for a mortgage REIT to be worthwhile in my opinion, they have to do more than just invest in pools of mortgage-backed securities. They need to invest in other businesses and offer additional services. I've noticed this is what really separates bad REITs from more worthwhile REITs. Where Orchid Island only invests in mortgage-backed securities, an REIT like Starwood Property Trust actually invests in both mortgages as well as physical properties. And then you've got Arbor Realty Trust, which invests in mortgages but also issues their own bridge loans, which are short-term and generally much safer. Ready Capital is another REIT, but they also acquire additional real estate companies so they can service SBC loans, construction loans, and other mortgage services. And as you can see, Sachem offers a wide range of services to their clients. They offer fix and flip loans for developers who want to purchase properties for the purpose of upgrading them and then selling them for a profit. They also offer construction loans for new housing developments, loans for distressed and foreclosed properties, commercial loans, and bridge loans, which as I just mentioned are short-term loans that are used until a company secures permanent financing or removes an existing obligation. If we look at their dividend distribution history, we can see that gap in their distributions back in 2020. The company didn't pay a dividend back in April of that year, which was right during the worst of the pandemic when every stock was tanking. That's the only time in this company's history where they didn't pay a dividend, and as previously mentioned, they fully restored it without missing any other dividend payments. Originally paying 5 cents per share back in 2017, Sachem was able to grow their dividends to 11 cents per share and then eventually to 12 cents per share. So while there hasn't been consistent growth, it is still offering a very high 10.5% dividend yield, which is excellent for those seeking income. One thing to keep in mind is that because this is a much smaller company, their stock is more thinly traded. You can see on this day only 269,000 shares of SACH were traded in the market. Building up an extremely large position in a thinly traded company is usually not a great idea, because if there was ever a situation where you needed to quickly sell most or all of your shares, there might actually not be enough buyers out there who are interested during that time. But as long as someone doesn't plan on acquiring hundreds of thousands of dollars worth of shares, there shouldn't be any issues. The majority of the loans in their debt portfolio expire this year. As I mentioned earlier, this is a company that likes to focus on very short-term investments. Roughly 92.3% of their portfolio consists of loans that expire this year, with 7.4% expiring next year. About 54% of their debt is invested in residential properties. Since the housing market is so hot right now, this helps explain why this company has been growing so rapidly. Nearly all of their debt is given to projects located in the state of Connecticut, with also Florida and New York also making up a large portion of their portfolio. Their revenue breakdown is also pretty exciting. It shows just how rapidly Sachem has been able to grow in the last 5 years. Since March of 2017, the total revenue they've brought in from their investments has increased almost 9-fold, which is really impressive. You can see the company earns revenue in 2 different ways, from interest received from issuing debt and also from fees. In many ways, REITs and business development companies have a lot of similarities in terms of how you would go about analyzing them. But both of their income from fees and interest have been increasing over the years, which is encouraging. So to summarize what we've looked at with Sachem Capital, I think things are going to continue to look good for this company as long as the housing market continues to grow. This slide in their investor presentation shows that current market conditions are greatly in favor of this company. The number of available housing inventory in the United States has been diminishing, and the number of single-family housing startups has also been increasing year over year for the past decade. Home price appreciation has also continued to grow, and there haven't been many new homes constructed after the year 2010. With the average home age continuing to go up, this favors both new housing construction as well as house flipping, areas Sachem is specializing in. Here's another slide that highlights the favorable conditions of house flipping. For nearly every year over the last decade, you can see the amount of money to be made from buying a home, installing upgrades, and then reselling it has never been more profitable for investors. So as long as things continue to move this way, I think Sachem is a company that's going to continue to grow financially. I know a lot of people have been predicting doom this year given how much stocks have fallen, but we still haven't seen a slowdown in the housing sector. Another thing to remember is that Sachem is still a very small company. Even though they invest in a lot of short-term debt like Arbor Realty, there's still typically more safety with larger portfolios. Plus, since their stock is so thinly traded, I think if you were to invest in them, it shouldn't make up too sizable of an amount of your total portfolio. I think it's a decent income stock to dabble in, but if we ever head into another housing crash or possibly a large-scale recession, I can see this company's stock price dropping pretty sharply. But of course, as I always like to say, be sure to perform your own due diligence and research before investing in any dividend stock. It's always a good idea to educate yourself on the company and the industry before spending any money on shares. Also be sure to diversify your dividend or income portfolio across different holdings in different sectors, including REITs, consumer staples, BDCs, energy stocks, etc. This will help reduce the amount of risk you're exposed to in case one of your holdings happens to cut their dividend distributions. You'll still be able to rely on your other holdings for income if you happen to be living off your investments. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.